There have been ship owners listed on Wall Street going back to the 1980s, but it was only in the mid-2000s, with the China trade boom, that the shipping industry really came to the U.S. public markets in a major way. In the 2 decades since then, there have been some controversies with these listed ship owners. These controversies have involved conflicts of interest, self-dealing by private sponsors and management to the detriment of common shareholders. I'm Greg Miller, senior reporter for Lloyd's List in New York. I've been covering listed shipping companies since the mid-2000s, and I can confirm there has been some questionable behavior over the years. There have been cases of public owners buying ships from their private sponsors at prices that are, shall we say, advantageous to the related party sponsors. There have been fees paid by the public companies to their sponsors for technical and commercial management at levels that have unduly enriched those sponsors. There have been public company managements that have conducted highly dilutive equity sales, wiping out over 90% of their own share value to raise money to buy ships from their own private companies. And there have been insiders that have had attractive offers to buy the public company, offers that would have enriched the common shareholders, but offers that were blocked because it was not in the interest of the insiders. When it comes to corporate governance, the good, the bad, and the ugly, there is one person who is considered the expert on this subject, equity analyst Michael Weber. Michael started his own firm, Weber Research, in 2019, and before that was the shipping analyst at Wells Fargo. Every year, Michael puts out a scorecard that ranks shipping companies based upon their corporate governance and ESG practices. It is very closely watched, and this year's rankings have just been released. So, who better to speak to about conflicts of interest than Michael? On this week's podcast, we talked to him at length about his famous scorecard, what it means, and how much progress he has actually seen. Hey, Michael, thanks for joining us.
Happy to be here. Thanks for having me.
So, you have been doing these annual rankings, I think since 2016, back when you were at Wells Fargo, whether it was labeled corporate governance or ESG. You've been doing these scorecards. So I guess just to start off, what's the basic premise? What's the thinking behind what this ranking means? And then secondly, what are investors supposed to do with this?
Yeah, so you're right. We started doing this, I think, 9 years ago. I had to go back and count this year. And honestly, it started with us, again, 2015, 2016, just kind of picking a fight, to be honest. Idea of corporate governance being a headwind for the space, had been around for quite a while. Like, we certainly were not the first ones to notice, even to the point that we had a number of clients that would reach out, become a talking point for them. And then over time, it just became so commonplace with them that they were really looking for a way to kind of get organized around it. But it really stemmed from the fact that, we've covered this space for 15 years, and the in some corners, in some areas, kind of the lack of governance was really a headwind towards valuations, towards the equity aspects of the space working in the way that they should. And so while we were at Wells, I think we had the number one team there for a couple of years at this point, so we felt that we had the cover to go in and do something like this. It took quite a while to put together. We had to be very conscious of the scope for something like this, because it is a very kind of emotive subject, especially among owners. And so we tried to create something that was very dry, that was quantitatively based, and really go in, aggregate the data, and then look at different ways to kind of compare and contrast. But in terms of how investors, owners, companies would use something like this, is really just to establish a basis and a baseline, right? So by no means is this the end all be all of the way someone should look at making investments. But we wanted to create something that created both kind of absolute metrics and relative metrics for people to look at when it comes to particularly corporate governance, but also some other factors as well. But really just to provide a baseline in an area where there had historically been quite a bit of haze.
Yeah, and just to be clear, I mean, as we both know, in shipping, there are these long sort of multi-year periods of mediocrity and sometimes disaster, and then you get these big booms. And so when markets are booming, the focus is really not on this.
Well, look, I don't know that I hear that a lot, and I don't know that that's accurate. I think when markets are ramping, you want to tend to get long the most beta you can, right? And you want to get long the most leverage you can, right? And it just happens to be that a lot of the companies that have that much beta, that have been generally beaten down, they're going to trade up with the rest of the group and may have more room to run than something that already gets a better valuation, are going to be companies that may not have great governance. But I hear that position that way a lot, that people, they don't care when the markets are going well. Like, no, they still care, right? But if a rising tide is going to lift all boats, and there's a story that's been has lagged and traded it's a massive systemic to NAV, and they also happen to have poor governance, that tends to get a disproportionate amount of capital flows. But that's a function of the capital markets. That's not related to people caring or not caring on ESG. I think if you were to look at people that are maybe investing across the cycle, I think there would certainly be a preference for companies where they're not at, those investors are not at some sort of systemic information disadvantage and looking at value leakage, over the course of a decade. Those capital flows in times where the market's poised to improve are going to go after the names that have the most room to run, and those tend to coincide with names that don't always have the best governance. But not always.
Yeah, so let's look at this year's rankings, which just came out. Number one, dry bulk owner Genco, which was first last year. Number two is Matson. Number three, LPG operator Navigator, up from 7 last year. So, let's just take Genco as an example, because they've been, at the top of the list so much. What is it about Genco that makes them rank so well with you?
Yeah, one of the things that you probably would notice within the model and within the scorecard rankings, and the tiers. Really, we focus on the tiers more than the ranks, but I understand why people like the ranks. You have companies that at one point had to restructure and then reemerge, be it 3, 4, 5, 7, 8 years ago. And generally with those companies, you had private equity interest or financial sponsor interest, and you saw them usher in best practices when it comes to board composition and roles, related party structures, and the like. So if you were to go through, and some of these companies some of the companies that used to be in the top quartile have gone private, but when you go through and look at some of these companies, they've restructured. So there was a period of time where Genco didn't rank particularly well within our metrics, and the model didn't treat it very well. But I would say that what still carries the most weight within our framework is going to be related party transactions. Now we break those into 4 buckets, including kind of management fees, S&P fees, general related party transactions, and commercial and technical management. And those are really kind of the systemic levers that you could see value kind of leave an entity, right? So those do carry a disproportionate amount of weight. So if you were to look at who populates the first quartile, be it Genco, Matson, Navigator, Ardmore, Pac-Base, and DHT, I can just read down the list. Typically, you don't see a lot of embedded related party structures in those entities. And when you're to look at, say, the bottom quartile, you have a lot of companies that have been public for quite a while, that went public at a time where that wasn't frowned upon quite as much. And to be honest, a lot of those companies had bankers that were telling them, "Oh, that's fine," right? So I wouldn't put all of the onus on those owners per se. But typically that's what's going to drive companies towards kind of the top of our model, towards the bottom of our model. And then when you get to the middle, and again, we cover, there's 64 companies within that we use within the model, or that populate the model. Within the middle, you do get a bit of a mix, right? So there you do get into different levels of disclosure, different best practices when it comes to the board turnover and things like that. But yeah, typically the companies towards the top are going to be the ones that have relatively clean structures. They tend to really prioritize capital stewardship and transparency, and provide a nice baseline for investors. But I don't know that there's any one magic bullet for Genco. The model likes the way they're structured. But I would say that there's a cluster of companies towards the top, a big middle section, then a smaller cluster way at the bottom.
Yeah. So now let's look at the other side of the spectrum. Let's look at the bottom. I see a lot of Greek microcaps here. Imperial Petroleum, which is new, is at the very bottom. Castor Maritime, second lowest. Funny story about Castor Maritime. A couple of years ago, I had hurt my arm and I was at a physical therapist, and a very nice guy, knew absolutely nothing about shipping whatsoever, and he had a massive position in Castor Maritime. And I was like, oh my God, don't do that. And then, going on from there, we have Toro, newly ranked spinoff of Castor. So what is it about, this bottom cluster here that is putting them at the bottom? Is that, really the related party structures?
Yeah. I mean, if you have all four of those related party transaction or related party relationships, those boxes checked, you're going to be at the bottom. There's almost no way to escape that. And I'm actually really glad you told that story, because that relates to a debate we have internally almost every year. Like, how many companies do we want to put in this thing? All right. And so, they're 4 quartiles, so we tend to look at multiples of 4. We keep 64 in, but when we add new companies, we tend to do that by market cap, and we always think about where should the market cap cutoff be. And what you just described is why we still include some companies that are 50 million in cap, 100 million in cap, because it's not Fidelity and Millennium that own those stocks, right? It's your physical therapist, right, who doesn't know anything about shipping but has some massive position in that name, has no idea the mechanisms behind the continual reverse splits, the perpetual dilution. So when you think about, especially some of the fundraising mechanisms down there, one of the reasons why we like to include those names in the scorecard is because you're really kind of scraping the bottom of the barrel when it comes to qualified investors at times with some of those names. Not every time, not in all cases, but you're typically dealing with folks that are naturally positioned to have an information disadvantage, right? Versus maybe some companies towards the top, and some larger cap names. But yeah, look, there are companies that have certainly moved out of that bottom quartile that have maybe adjusted their structures to the extent possible. I am very sensitive and understand the fact that if you're a public company that's been out there for 10, 15 years, it's very difficult to do a wholesale switch from a related party vessel manager to something that's owned internally. I remember Diana doing it a few years ago. It was a big deal. It costs money, right? So there's going to be a transaction there to get that done. So I certainly understand the position some of those companies find themselves in. That said, we don't measure intent, right? So whether it's there or not is what we're going to measure, right? And we don't necessarily measure whether it's being abused or not. We like to say we evaluate the race car, not the driver, right? And so you've got this issue. We're going to call it out in the model, and you're going to get penalized for it. But certainly, those embedded related party structures are going to weigh a company down into the 4th quartile if they're checking a bunch of those boxes.
Yeah, and on these guys on the bottom, a lot of these names were involved in a situation that we had in shipping that was, corporate governance related and negatively reflected upon the reputation, and that was these dilutive offerings. I think all but one were done by Maxim Investment Bank with the Greek microcaps. I think it started around 2020, and they pretty much stopped in early 2023. And for those to work, the shares and the warrants were bought by small hedge fund intermediaries. And then they were flipped to retail traders like my physical therapist, who were then there to gamble. And they just loved the volatility. I mean, this was the time of the meme stocks and GameStop. Do you think that, we haven't seen this in a while, do you think, at least from the shipping perspective, that whole model has essentially been priced out, or do you think it could return?
Yeah, I don't know that a model like that is necessarily going to be driven by like relative pricing factors. To the point that that mechanism would be priced out. I think that would the solution for something like that would need to come from the regulatory side. So I always hesitate to say whether we would never see something again. The relatively rigid framework we use within the model kind of cuts both ways, right? So you mentioned the warrants and the mechanism used by some of those companies. Like, some of that gets captured in the model, but not all of it, right? So we'd have to look at the same factors for everybody. But yeah, I think by and large they're checking enough of the other boxes that I think they're ranked and tiered appropriately. Do I think that appetite for that is gone? No, I don't. But again, I think the solution there would probably be regulatory in nature. And then look, there's also an argument to be had that, okay, there's no one putting a gun to anybody's head saying, you've got to buy this, right? But I'm also conscious of the fact that that's the same rationale that drug dealers use, right? And to some degree, right? And so, how do you solve that problem if there is a willing buyer at that price to step in and they're saying they understand the risks? I think it's a regulatory solution versus anything else. But we try to be pretty cold and calculated with the way we evaluate, these structures, right? So some of what you described would be captured within our framework, some of it wouldn't, but we do tend to think it shakes out where it should.
And the other thing I see sort of at the bottom of the list is no carbon disclosures. I'm just wondering that if we could just talk about the whole list and, carbon disclosures. This is something that's come to the market in the last couple of years. And, how do you think everyone's done?
By and large, I'm actually pretty happy with it. I think, if anything, I think the space has not necessarily been treated very fairly the past year or two. And I think you've seen owners, maybe not all owners, but a number of owners, be proactive in terms of what they're disclosing, how they're thinking about their emissions profiles. But I think more than anything, I think that I don't know that we'll ever get to 100%, disclosure unless it's mandated, and which it is, and we'll get to the timeline where everyone will disclose it. But when you start moving past governance, you do start seeing quite a bit of emission creep around ESG in general. And I've debated the last couple of years whether or not to change the title of our model and our note back to corporate governance. But we do look at carbon disclosures, and we will continue to. But we do just focus on whether or not it's being disclosed and whether the information is being provided so that investors can make their own decisions on it. But all of those factors, when you start thinking about measuring those emissions or other social factors, create some very slippery slopes, and it becomes increasingly difficult to quantitatively measure them in a way that we think is fair. If you were to measure emissions, right, you would, just about anybody with an older fleet probably would not score quite as well. But then what are you saying? You're saying there's no room in the space for older tonnage? Like, if we got rid of all the tonnage over 15 years, we'd be in we'd have a lot bigger issues than simply, marginal, carbon emissions. And so the line for us stops at, are you disclosing this? And that's where it's going to continue to stop. But yeah, in general, I am pretty happy with how proactive the industry has been around this. And there are definitely folks that prioritize it, and there are definitely some capital providers and financial sponsors that, that can reward that with premium valuations. But, for us, the idea is disclosure and transparency within this particular piece, the one we do once a year, right? So it's just, are you making this, are you disclosing this, and are you structured in a way where investors are not at a information disadvantage?
Yeah, I mean, and you brought up the ESG aspect, and I completely understand how companies being a good steward of capital would affect their valuation. But I mean, let me just play devil's advocate here. What would you say on the E and the S? Do shipping investors really care if the board is five old white men and there's no diversity? Do they really care from the environmental carbon perspective? And when you think about it, much of the shipping industry transports carbon. It facilitates the fossil fuel industry. So it seems like it inherently could be a sector where green investors wouldn't even looking at the first place. So
yeah,
going to ESG, I get it on the corporate governance, but I'm skeptical on the social and the environmental issues, whether you can really see that reflected in a shipping stock price.
Yeah, I think many don't, and probably many shouldn't, right? I think that we're not on a soapbox saying you have to do these things and you have to have this level of diversity and check all these boxes. What we're basically saying is that the position we're taking is that there are certain things that we think probably should be disclosed, Your question on if a board's made up of, 5 old white men. From our perspective, I think it's up to the investor, right? And I think originally when you start looking at like something like board diversity, it's, are you getting a diversity of opinion, right? And in general, having a diversity of opinion is generally something that's pretty helpful. Now, the most obvious initial question from that is, okay, well, where do you draw the line? Like how much, and where does that diversity of opinion come from? Does it come from, some social factor? Does it come from, just someone working in a different space for quite a while? So I think that comes down to, the individual company, and do they think they're getting the right range of opinions and perspective that they can make the best decisions possible for investors. But I would completely agree that I think that, how an investor would go about picking a portfolio or picking their exposure is always going to be up to them, right? And so what our scorecard focuses on is enough data being provided that they can make those decisions, right? So if you notice, we actually get criticized quite a bit that our scorecard really doesn't do much of anything on the social side, and only takes a very cold binary approach to carbon disclosure, and that's by design. Like we have no interest in delving into kind of the black holes of kind of social issues and what's right and what's wrong when it comes to certain aspects of the way a company should be managed, and especially when it comes down to like, how do you quantitatively measure that? So not to say they're not important, not to say that people don't have the right to care about that and to prioritize that when they come to picking stocks, but I would say that in terms of what we tend to find that investors prioritize is corporate governance, and then making sure there's enough transparency and data available that if there are other factors that they want to prioritize, they're able to do that.
Final question. I mean, corporate governance, you've been doing this for 9 years. If you think back to the first year you did this and, went through the list and looked at practices, and if you look at what the practices are of shipping in general today, how much of, how much progress has there been? Has this actually helped valuations? And then to put it in the context for the future, I mean, how far do we have to go?
Yeah, like I think it has been helpful. I think there's always kind of a limit to what it would actually do. We've definitely seen, I think, the bar generally go up for what's acceptable. By no means do I think that this scorecard is the only thing that's done that, right? I mean, you've had the Poseidon principles. You've had a general kind of wave of people caring on this, and baseline levels of governance and transparency going up. But I definitely think there's been progress. I think there are always going to be laggards. But what we would really care on is where is that median bar of what's acceptable for a proper new issuance to get done. And I think if we were looking at it today versus 9 years ago, I think the bar is higher today than it was 9 years ago when it comes to transparency and fair dealing, right? So I would also say, like, look, when we published this thing 9 years ago, the title of that note was not ESG scorecard rankings or corporate governance. It was shipping's corporate governance war, right? And we took a pretty aggressive approach with it. And so I think that coming from those days, right, where there was a ton of concern around it, I think those concerns are still there. But when you look at the largest cap names in the space, when you look at where the flight to quality candidates really are, by and large, I think the governance is generally better there. But again, this is almost meant to be a bit of a mirror, right? To reflect, okay, where do transparency levels need to be? And if we are helpful in bumping those levels and making the space just a little bit cleaner so that there's an environment where a company can go get a premium valuation that it's there, that's kind of the ultimate goal. But I would say I don't get as many nasty emails or phone calls as I used to. I think people are generally accepting of what's in it and what's not, and what we measure and what we don't. I used to get a ton from folks kind of all over the scorecard, to be honest. But I think the methodology is generally accepted. I think people understand what it is and what it isn't, and I'm pretty happy with the trajectory as a whole, right? You get enough altitude on this and you kind of look at where it started and where it is now. I think it's generally been pretty successful.
There you have it. Corporate governance guru Michael Weber on the current state of play. It's a very important subject, very important to how shipping stocks are priced. If shipping managements can do a better job at this, it should really help cut down on those discounts. I hope you enjoyed the conversation. Thanks to Michael for speaking with us, and as always, thanks to you for listening. We'll be back next week with more of the stories that shape shipping.